Hello, namaste. No prizes for guessing. You are with Deepak R. Khemani on the 2 Minutes Money and Personal Finance Show. Continuing where we left off in the debt fund category space of mutual funds. We've seen liquid funds, ultra short-term bond funds, and medium-term funds. Let's come to a category which is very, very popular among investors for investing in debt funds. Why? Because there are chances of this category giving higher returns than all the other previous categories we've seen, and also giving higher returns than fixed deposit from most banks. Why? Because in a corporate bond fund, the money you give to a mutual fund manager, he is mandated to invest 80% of the money in corporate bonds, corporate paper. What does that mean? Most big corporates and small corporates in India require money for their business purposes. This money will be lent to corporates. Now, in the previous funds which we saw, the earlier ones, the liquid, the short-term bond funds, most of that category isn't going a lot to corporates, probably a small part. Here, 80% plus needs to go to corporates. Chances are, because it is going to corporates and corporates need money, the rate of return on these investments is higher compared to what you would get in a bank FD. You also need to understand the tax implications. When you are keeping money in an FD, the whole amount, the full interest which you receive every year is taxable. So if you are in the 30% tax slab, you will pay 30% tax. In a mutual fund, if you are not using the withdrawal option, you are going in for the growth option, you do not pay any tax, zero tax every year. In the year of withdrawal, when you withdraw the money, if it is before 3 years, you will be liable to pay short-term capital gains tax, which is, in this case, the actual income tax slab you are in. However, once you cross 3 years, then this investment becomes very, very attractive because you get indexation facility which reduces the amount of net tax payable. If you are a senior citizen, even not a senior citizen, and in the 30% tax slab, and you are looking for better tax adjusted returns, the corporate bond fund is a good category to look at. As always, remember, mutual fund investments are subject to market risks. Always consult your financial advisor, your investment advisor, who knows your risks and who knows which fund may be the right fund for you. Why? Because corporate fund from ABC mutual fund and XYZ mutual fund, even though the name is the same, may be totally different. It may be taking higher risks or lower risks. Check that out and then decide to invest. Happy investing.